Hey there, everybody. Today we are going to cover Chapter 6, the first of two chapters that is going to consider a company's internal control. We've talked about internal control briefly in the past when we were discussing the risk assessment stage of the audit. Remember that auditors are required to gain an understanding of a company's internal control during this risk assessment stage, and also gaining this understanding of internal control helps them plan the audit in the future. So once they move to the risk response phase, they may decide to test specific internal controls in order to reduce the amount of substantive tests they do in other areas of the audit. So this is a really important area for companies' executives to consider. Internal controls help to safeguard assets and information. And there's actually an organization called the Committee of Sponsoring Organizations, COSO, for short, also referred to as the Treadway Commission. And this particular entity kind of writes the rule books for internal control. So basically kind of outlines what good internal control policies look like. So we can see here that there's three different objectives of internal control that the COSO framework lays out. So this is important for companies at a high level. First off, we have operations objectives. So these are just different internal controls that are put in place to safeguard a company's operations. Think of a security system being put in place maybe to safeguard assets. That would be an example of the operation objective of internal control. Now, as an auditor, we're interested in all three of these different types of objectives, but maybe the most important one is this reporting objective, because this is the objective of internal control that kind of governs the oversight of the production of internal reporting and the reporting of financial information. So we're very interested in making sure internal controls within a company that oversee the production of the financial statements are in fact in good order. And also a third category here, which is of interest to auditors, is the compliance objectives. Basically, these are objectives surrounding internal control that make sure that a company is meeting any laws or regulations that govern that particular industry. So for instance, maybe we have a company that produces some types of goods, manufacturing company, and there's certain environmental regulations that they have to live up to. Well, they want to have internal controls in place to make sure they're not breaking any of these regulations. So that would be what we call a compliance objective of internal control. Now we can see here this kind of graphical cube that outlines the relationship amongst the three dimensions of internal control. Notice on the top of the cube we have the main objectives that we just talked about: operations, reporting, and compliance. And here in the center of the cube is where we're going to spend most of our time this chapter, talking about the five individual components of internal control. So COSO has 17 principles laid out that kind of govern the application of good internal control policies. So we're going to discuss each one of these five components and the related principles associated with each component down the road. And also the kind of third part of the cube here, the third face of the cube, is how internal controls work throughout the organizational structure, from the entity level all the way down to individual functional level. So internal controls at the entity level are kind of high-level controls that govern internal control throughout the whole company. So for instance, when we talk about the control environments, we're going to note that a good internal control would be having management that has procedures and processes laid out that help communicate internal control to the workers throughout the company and stress the importance of internal control. All right, so that's one principle of internal control. It's at kind of a higher level. That's gonna, go all the way throughout the company. That particular aspect of internal control, all right, is company-wide, as opposed to transaction level internal controls, which govern internal control over one specific function of the company. So imagine an internal control put in place to help out with a payroll process. Maybe one particular control there would be that somebody has to sign off on payroll records before the payroll checks could actually be produced. So there's been numerous frauds where people have gotten paid. Folks who weren't even on the payroll got paid. They received paychecks. So we want to have somebody who oversees payroll, that signs off that yes, actually people receiving payroll checks have worked for the company and are deserving of being compensated. So that's one internal control that governs a specific function. We call those transaction level controls. And auditors are interested in identifying what can go wrong. We have this kind of shorthand acronym WCGW for financial statement assertion. So a lot of our work as auditors when dealing with internal controls is thinking about how can the internal controls break down what could possibly go wrong with these internal controls. And then after we do that analysis, we can kind of use that output to figure out where we need to focus our attention kind of going forward. So internal controls aren't foolproof. Even if we have great internal controls in place of the company and the company's living up to these 17 principles that COSO has established, we could still have some problems. There's still inherent limitations to internal control. So think about from your own personal lives, maybe an example of this would be you have a security system installed at your house. Maybe you pay a lot of money to get this system installed. You maybe pay a monthly fee to keep it operational. So that's a great thing to have in place. That's an internal control for your personal residential household that helps protect your assets. Well, if you leave your house and you go on vacation and you forget to turn the security system on, it doesn't matter that you have this great control in place. All right, that control isn't going to do much for you. So likewise, with internal controls put in for a business, there's inherent limitations. So we can see here a number of different examples of breakdowns of internal control. A couple key ones I want to highlight. The ability of management to override internal controls. This may be necessary. There might be instances where it's actually necessary for management to override an internal control, but this could be problematic. Imagine a situation where a company wants to assure that all customers receive a standard price for their goods. Basically, they don't want to have any preferential pricing, so they put internal controls in place which assure that everybody's receiving the same price. Well, if the CEO can override that control, that could be problematic. Perhaps they decide to give a preferential price to a friend or a business acquaintance. All right, in that case, the internal control is being overridden. That's problematic. There's ethical ramifications, possibly legal ramifications in that situation. So that's a possible issue with internal control. We have the control in place, but that ability for management to override it can lead to a breakdown of what the control was initially supposed to protect against. Now, again, there might be good reason why you'd want management to have this override ability, but we have to keep in mind that can be problematic in some cases. Also, another big issue is collusion by two or more individuals to kind of circumvent the internal control. So imagine we have, again, kind of a situation where an internal control is put in place that the purchasing department is not allowed to pay more than X dollars for certain goods. All right, so that's a standard control put in place to help prevent misuse of company funds. Well, if the purchasing manager has the ability to override that control or approve purchases in excess of that predetermined amount, that could be problematic because they could be in cahoots with, say, the purchasing clerk, the person that actually goes out and makes the purchases for the company. They can get together and basically the purchasing clerk can go out and purchase stuff from other companies at a higher price than what's actually fair value. That company can give them a kickback. So if they're working with a purchasing manager, all right, they could work together to circumvent the system.